Good evening, everyone. You're all very welcome to our weekly market webinar. I'm going through the kind of the major themes in the markets this week. Of course, factoring in on current sentiment, of course, which we'll be going through shortly. Tonight's call, we'll be talking about the likes of the volatility curves, the impressive movements in gold, and of course the continued equity rally that we are seeing in the backdrop. So a lot of different moving parts this week on a multi-asset basis, and of course we've seen the volatility in terms of price action structure develop across the board in all asset classes. Now, of course, as we turn our attention to I suppose the macro side of things this week, we talked about it last week briefly. This week is really all eyes on central banks. So of course, obviously yesterday, Monday, starting off the week, following the clock change in the UK, and of course the US clock change will come next week, so you'll see that reflected into broker times. And of course data prints this week, so traditionally a lot of data prints that would have been 3 are now 2. Any data prints that would come out of half 1 is obviously factoring in as well beyond that. And of course with the shutdown, it means that we have a lot less data prints, of course, in the backdrop, particularly in the US, as things remain normalized in Europe. So back to the pinnacle, as I mentioned there a moment ago, all eyes this week, as I said, is going to be on the central banks. We've got Bank of Canada on Wednesday afternoon. We've got the Fed on Wednesday evening, our usual kind of Fed meeting every kind of 6 to 8 weeks or so. And then, of course, on Thursday overnight, as we move into the Asia session, of course, we are back in Japan with a BOJ interest rate meeting. So a lot of central banks on the wires this week. And, of course, we do have still a lot of data prints in Europe. But really kind of all eyes, considering, of course, we got the CPI prints last week in the US. It'll be very interesting to see actually whether we get our GDPs or core PCEs, etc., or PMIs or ISMs over the next few days into, obviously, next week, of course, starting November. And, of course, if you're to look at recent votes, 60% requirement to end the shutdown in the US, and of course we've had 55. So, and majority of those voting against the shutdown are actually Democrats. So it'll be interesting to see whether this Democrat-fueled shutdown actually continues in the US, given so many of the American public, 40 million, has not received their SNAP benefits. And of course that's something that is driving a lot of people very, very interestingly, and of course not surprisingly, anger in those jurisdictions and in those lower class regions as well. So as I said, as we move into Halloween on Friday, midterms as well is going to factor into volume this week as well, indirectly. And of course, that's something that as traders we need to be conscious of. But as I said, for me, the big talking points this really this week is, of course, the central banks. And then really kind of setting the tone beyond that. Now, as I said, when we look at central banks this week, we are expecting that kind of continued cut across the board. So Fed's cutting from 4.25 down into 4. That's pretty much logged in. And it really then becomes the case of, do we then see a successive third cut in December? Given, of course, we've actually seen recently 25 basis points. We did talk about it in terms of August and September, really seeing 3 consecutive cuts. We've got one. We're expected to see a second by the Fed. And of course, a third in December would see rates go to 3.75%. And that becomes quite interesting, of course, even though, as I said last week, if you were to look at the CPI data, the core of the headline, the month-on-month inflation prints all went up, and a lot of that is due to really the shelter composition weighting of the CPI print. And of course, that's just really been driven by the fact of this narrative and kind of clear bias in terms of the property prices. And of course, we have seen, obviously, with those higher interest rates, the mortgage repayments are obviously gone through the roof in the US. And not surprisingly, as I said, for those landlords, they're seeing massive capital appreciation in their property prices really since 2021. Since we saw this real wash of liquidity flowing into the markets. And of course, we had to see that kind of subsequently die off in 2022 into 2023. But as I said, with these overinflated accommodation property prices in the US, it's not surprising that we are still seeing those CPI inflation prints becoming quite sticky. And that, of course, is in the face of the Fed wanting and having to cut those interest rates, and that's obviously something that we've seen quite heavily under Scott Bessent as head of Treasury over the last, as I said, 6 months or so. So interesting across the board, pretty much as you see it. Bank of Canada expected to cut. Fed expected to cut on Wednesday. But as I said, some of those other data prints is really going to be interesting. As I said, given we got the CPI prints last week, I really want to see, do we get an end of a shutdown this week where we can actually start to see how the current growth dynamic is? Because of course we've been shut down for the last month. We haven't seen any sort of growth statistics, and of course if we don't get it now, do we then start to see a shift in the economic calendar over the next 4 weeks if it's a case the shutdown ends, or do we see actually the calendar remain as set? And again, we have to wait then until the end of November for latest GDP prints, and as I said, that'll be something really worth watching as we move into November. So really, in simple terms, 3 central bank meetings this week, 2 expected to cut of the major kind of G7, G10. And then, of course, we're looking out at the European data prints in the back end. So German GDP on Thursday into Halloween is going to be very, very interesting. Eurozone broadly. GDP in US, as I said, not sure whether we're going to get it or not. And then, of course, on Thursday, something that I haven't mentioned is the ECB refinancing operations rate as well coming through. So we have 4 interest rate meetings in total, which I think is going to be quite interesting. It'll be interesting to see whether the ECB in Europe follow suit with the Bank of Canada. And of course the Fed in terms of potentially cutting their rates, but given they are much deeper in their cutting cycle at 2.15%, it doesn't leave them much capacity on for cutting rates into year end. In a case of a European-wide recession next year, whereby they then really have to start cutting rates more aggressively down into that 0% level. So that would really be of interest as we move into 2026, more broadly speaking. So 4 interest rates this week, 2 expected to cut, 2 expected to hold. And then, of course, we have German Eurozone GDP prints with the US, whether we get them or not is another story. And then, of course, Friday we have PMIs, ISMs, core and harmonized consumer price index in Europe and Germany. And then, of course, retail sales with US data prints as well. As I said, really an anomaly whether we get these data prints. Hopefully we do. If not, it's going to push out the data prints curve for another month, which really just kind of sees this equity rally just continue because of how dovish the Fed is going to have to be in the face of all of this. So on a surface, quite a lot to digest this week. On an earnings side of things, not really too much over the next week or so. These are kind of the confirmed company reports. Of course, most are kind of medical, pharmaceutical companies. So obviously we're seeing Moderna, Biogen, Pfizer, to name just a few, and of course Lilly as well reporting on Thursday. But overall, we're not getting any of our major kind of G7, G10 or kind of or more Mag 7, should I say, stocks like Tesla, Amazon, Apple just yet, and that's really going to flow into kind of 18th, 20th, 25th, 27th. Over the next number of weeks, more broadly speaking. So interesting to see how does that develop in terms of an earnings perspective, because of course that was obviously something that we saw so massively outperform in H1 when we saw those equity reports published in July. So again, another fairly interesting dynamic to look out for. Now, on the session today, as we move back into price structure, we've obviously seen a lot of to and fro and back and forth. So for example, we saw that VIX curve on Wednesday into Thursday last week get a run up, and then of course we saw that secondary wave lower, and we talked about it last week. We said it on Thursday Zoom. Once we start to see the VIX curve break back into this 18.5 handle, you would not expect anything else other than this to move lower. And that is exactly what's happened. We called this on the nose on Thursday, looking for that breakdown. We got it. And it was really just a case of actually seeing it return. And we got it back into this prior range. Something that we were quite vocal on last week between that kind of 16 and 17 print. And actually what we saw on Friday into Monday, we actually gapped down. So we went from 16.5 down into those 15 thresholds. Now we've seen a little bit of a bite back today in the VIX. Short-term movements, and of course that gap fill from the beginning of the week has filled, but overall you'd actually have to say this has been very, very helpful for obviously the equity side of things, because of course when we look at the risk denominated profiles, what have we seen? Well, we've seen the S&Ps, we've seen the NAS, we've seen equity markets more broadly, with the exception of some of the European indices, move quite well. Of course on Friday we got to new all-time highs, we got to 6800s, then of course we gapped higher into Monday, and then really since then we've seen a little bit of inflection point, as I said, with the VIX kind of pulling back a little bit. But over the last few days, equity markets quite aggressively moving back up, and that trend, fighting that trend like we saw in gold for the last number of months, continues to play out as these markets move higher. Now we've seen it as well in the NASDAQ. Complete capitulation and breakthrough of previous highs on Friday as we closed stronger, 25.4. We then got the gap higher as well in the NASDAQ. And since then, it's just been clear and an overwhelming impetus to the upside. And of course, that's not really surprising when we talked about it on Thursday with this VIX curve steepening to the downside. Now, as I said, into year end, QE, potentially beginning, global liquidity on the rise into Q4. Everything that we've been talking about for the last few months, we've been talking about this Q4 rally. We've been looking at kind of 66. We revised up to 6,800 on the S&Ps. We've completely blown through some of these even bullish targets that we had in the likes of the S&Ps and some of these other risk-denominated indices, and markets is continuing to attribute higher gains. And that is, of course, seeing S&Ps today above 6,900. And of course, you only have to look at the future side of things as well, where you're seeing this kind of complete and overarching breakout. We saw it in the CFD market, in the options market. We've also seen that market again, and it'll really be interesting to see if there's any sort of pullback this week off the back of the FOMC. These weekly gap opens will be what I'll be looking at. So for me on futures, that 68.25 into 68.40, on CFDs down around the 6,800 level, those would be the dip retracements. Now if you were to get any sort of risk aversion on Fed FOMC, then you've got a deeper runoff through 6,800s back into 6750s, and these create those dip scenarios, right, where we get an impulse, we get a new high, then we get a pullback, then we get a correction, then markets resume, risk on, and then we ultimately take out those prior highs and ultimately kick on. So from my perspective, these are the two areas that I'm looking at for downside correction. So if there's any sort of downside correction, if there's any sort of risk aversion on FOMC, 6,800, 6750s, and these become dip rallies, similar to what we saw on the 7th of October, similar to what we saw back at the end of July, beginning of August, because every time there's that 3 to 5% correction in these markets, it is taken higher. And as I said, with monetary liquidity ticking higher into Q4, it's really just a case of, can you find the dip opportunity and buy the goddamn dip? Because that is exactly what we've seen month after month, case after case, since those cemented April lows in these equity markets. And of course, you only have to go out to the higher time frame. This is the longer run curve. Massive sell-off, and of course the trend has been very, very clear, very, very overarching over the last, as I said, 6 to 8 months. And of course you only have to look at the NASDAQ, where it's now up 40% since those April corrections, and how much liquidity, 9 trillion, they reckon, 9.5 trillion in money market funds that has missed this rally. And that is very, very clear when you look at the risk orientation, the risk segmentation, and of course the fundamentals underlying all of that, with, as I said a moment ago, liquidity taken higher, QT ending, potential or probability for QE coming through into H1 2026. So as I said, any sort of dip opportunities, I wouldn't really be surprised if there was a pullback into FOMC, or at least potential short-term counteraction. But as I said, it wouldn't be any way underwhelming if we were to see moves back to 6,800. Now, whether that happens or not, obviously, let's wait and see. Futures, equity markets more broadly, continue to grind higher. And that's a similar scenario for the NASDAQ as well. Gap area around 25.4. Prior all-time highs at 25.2, they become pullbacks if it's a case we get a kind of an apex. So we talk about this apex structure where markets siphons out assimilated upside progression, and then of course we get our tops, we get a break of prior value areas, and then markets dumps back on itself back to kind of critical levels. And as I said, these types of areas would not be surprising if they were to be met. And of course we talk about this apex, the V bottoms, the A tops very, very frequently. And of course you only have to look at some of the V bottoms that we've seen over recent weeks as well in the back end. So equity markets more broadly holding up brilliantly. In other risk denominated terms, we've obviously seen the crypto space get a little bit of a run up. So Tuesday, Wednesday last week, we saw markets move off of those 106, 108 bottoms. We got to as high as 106 into Monday's open. Again, short-term ceiling price actions come back, and even over the last hour or so, as I was watching BTC at around 114, we're now trading at 112s and change, and it really wouldn't be surprising if we actually saw short-term move lower. So from my perspective here, it's a case of high probability conviction. S&Ps tonight probably moves back to value area. NASDAQ probably moves back to value area. Whether that happens or not, well, let's wait and see. For me, if that does happen, you're kind of looking at about 100 points off on NAS. You're looking at probably 15 to 20 points off, shaded off the S&Ps. And then, of course, the BTC rally undoes and really kind of finds a little bit of fair value, which for me is back in between this kind of 109.5 handle up to as high as kind of 111, and that's kind of really where it's pointing to tonight. So really wouldn't be surprised, as I said, particularly when you look at the volume side of things, if we were to see kind of BTC flow lower back into this yellow area. And of course, seeing it again with Ethereum, very, very sharp correction, which we talked about previously in October, finding that 3700 bottom. We've been pretty much migrating back and forth between 3700 and 43s in accumulation. Again, short-term tops today of 42, markets stifling lower, and as I said, really wouldn't be surprised, as I said, if we were to see Ethereum back into that 3800 handle in the back end. So what I'm trying to say is, in essence, short-term perspective, VIX obviously rolled off, which created that ability for these risk-denominated assets to move higher into the beginning of this week. We're seeing a little bit of a bite back today in the VIX curve, but again, interesting to see whether that continues into tonight's close more broadly, and if there's a little bit of a bounce back, because of course when you go to the daily curve on the VIX, there's been a lot of trading volume here between kind of 15 and 17. So when we come into these 15s, we get a little bit of a bounce back into 17 and a half, and you only have to look at the volatility in September. Back and forth, back and forth, back and forth between this region until we had that spike in volatility on the 10th, 11th of October. And then, of course, since then, it's a course of what goes up, comes back down eventually. Risk segments to the upside. VIX volatility curve undoes, unwinds, returns back to that prior median range. And, of course, today, really would it be surprising if we were to see the VIX again, particularly into Wednesday with the FOMC, move back up into the 17.5 handle. Really wouldn't be surprised, of course, given, of course, with the gap close here. So what I would say is, over the next few weeks, or next few days in particular, next few sessions, is depending on kind of what comes into Wednesday and Wednesday's FOMC, really depends on how the VIX curve reacts over the next few trading days. We could very easily kind of gather kind of sentiment accumulation here between that 15-17 handle, which for me is the scenario to see, well, if we were to see kind of 15s and 17s being kind of the migrated range over the next few days, well then, as I said, that really does allow for short-term correction in S&Ps, short-term correction in NASDAQ, short-term correction in some of these other risk-denominated assets. So as I said, from a volatility side of things, we have to be nimble that markets are moving in both directions with significant haste, right? Every time we see an upside spike in the VIX, we obviously get those 3 to 5% corrections in the S&Ps. But as I said, simultaneously, when we start to get those roll-offs, those unwinds in the VIX curve, that's when you start to probably see a little bit of short-term profit taking as equity markets moves to new highs. And you're seeing that kind of cyclical rotation, right? That's really all this is, a cyclical rotation, buying dips, running into new highs, creating those correctional plays, and then, of course, loading up when there is those very, very clear, obvious pullbacks. It has been probably one of the easiest things to spot through the course of this calendar year, particularly, as I said, from those April, May bottoms in particular. And that is obviously something that we focused quite heavily on here with our traders. So that's really kind of what I'm kind of pointing out tonight. When you look at it across asset basis, what's more interesting, as I said, whether we see a kind of a repeat in terms of other assets. So when we move out of equity markets into kind of crypto, for me the big thing is this quarter. Last year, when we saw the Fed increasing its rates, we actually saw an increase in strength in the dollar. Provisionally, we saw that happen in September. So when the Fed cut in September, from that September cut, we've gone from 96.5 with change on the DXY all the way into kind of 98.5. Now, for me, as I said, if we see repetitive or continued cuts in November this week, or in October, November this week, and then of course into Christmas with 2 more cuts, do we actually see the ability for the DXY to continue this bullish trend? And of course, we talked about it last week, this higher high, higher low, higher high, higher low. This is, for me, is the first time when we haven't created a new higher low, higher high, higher low scenario in this kind of trend structure, right? So from September lows to where we currently are at, and we have to ask ourselves, is this a period of short-term consolidation, or is this something more material that maybe sees the DXY become more consolidation between this 98 and 99 handle, for which we talked about last week? Or do we get that overarching breakthrough and really looking to see, does that DXY get a leg higher? And as I said, I really would not be surprised, even though the technical structures doesn't illustrate that, I would not be surprised if we were to see that DXY run higher following Wednesday's FOMC meeting, if we were to see another cut. And that's just what I'm saying there, that there is obviously the risk on, risk off narrative. Who's to say or who's to know what can happen, because of course you get a lot of pre-pricing. But when you look at statistically what happened in 2017, 2018 under the Trump 1 administration, and you saw what happened last year, calendar year 2024, wouldn't be remotely surprised, as I said, if we were to see further DXY strength. Now, of course, when we look at the foreign exchange markets, the euro dollar has been very much hung between that 1650 handle more broadly. We talked about it last week. We apexed up, we got below it. We've had a pretty much a steady grind back into that 1650 handle, and we are trading slightly above it tonight. But again, very interesting to see what happens here, if there's a pivot higher, pivot lower. I'm really kind of looking to see what happens that DXY over the next, as I said, couple of trading sessions. And I said if we're above 99 last week, I said at least short-term dollar strength was kind of upside tilting. But then as we saw markets, and that particularly that VIX curve steepening to the downside on Thursday, for me it was a case of, well, let's just focus on the VIX curve, let's just see if that risk rally continues. And of course that was the easier play, rather than trying to look at maybe taking dollar longs, because as I said, it wasn't really a feasible opportunity with that VIX rolling over. So interesting to look at as we move into Wednesday's FOMC. In other terms, we've obviously seen this complete unwind in gold. So we talked about this dead cat bounce into that 4160, 4170 last Tuesday into last Wednesday. We got it there on Thursday, and it really just unwound. And this is again is kind of looking at structural plays. So top formation breaking down, new anchored low, dead cat bounce recovery back into that value area, and then of course seeing that gold price completely capitulate from 4150, 4160 all the way down at that 3900. And that was pretty much this consolidationary area from the beginning of October. So this is all 1 month's movement. So this is where we started off October. We had that consolidation, we had that aggressive break, we had the retest, and then we saw that really echelon break higher where we went from 3900 to 44s. And really since then it's just been kind of apex. It's a larger term apex where we've gone from basically breakout all the way back down, a little bit of a reaction, and interested to see how does it play out into month end, into FOMC on Wednesday. Does the 39 buyers actually hold up, or do we capitulate lower beyond 39s? If we capitulate lower beyond 39s, we could actually be looking at a wider correction in this in this gold price. And you can already see from the Monday the 20th open to kind of where we are now, already gold prices is off about what are we talking, from basically 9% from the closure of last Monday to where we are tonight. And of course, if we were to see a kind of a 20% correction, which is something we talk about in terms of bear markets, that really doesn't see gold sitting anywhere under or anywhere above 37s. It actually sees it flowing much deeper than that. Now, whether we get a 20% correction in gold, really very, very early to tell. But I think on Wednesday, a clear break of 3900 sets up for a deeper apex. And that for me is going to be very interesting, because of course this was the 3-4 month accumulation before we had this aggressive breakout. And of course that would not be surprising if we were to see an even deeper correction, which we saw then a rotation from gold buying into gold selling, and then of course BTC selling into BTC buying, where we then actually progress higher back up into those mid 120s and all-time highs at 125 and change. So keep an eye on that one over the next week or so. I think FOMC, I think on Wednesday is going to be very interesting because, of course, we've got no data prints in the US. How does the Fed react to that? Because it's obviously something we're not massively used to. We see shutdowns quite often in the US, but we don't see shutdowns for this kind of period of time, and how it affects economic data, but also how it affects the Fed's policy stance, given of course their mandate is full employment and stable prices. So obviously stable prices, stable stock markets comes in directly into the back of that, even though it's not their primary mandate, but it's something that obviously they're going to be watching very, very closely for. Other than that, obviously, as we move out of gold prices, gold 3,900, as I said, is really worth watching. We've got a dead cat bounce tonight. We're actually trading back under today's value area around 39.52. I think a break underneath 39.40, 45 probably sees another runoff back into these lows again, and then it's a case of into Wednesday, does that 39 barometer hold up? And of course that's something that we'll look at tomorrow as we move into obviously FOMCs this week. So again, another interesting scenario is the oil play. So we talked about that dead cat bounce recovery last week in oil. We got it really moving back into that 62 handles. We talked about this kind of 61, 62 handle last week. And incidentally, the gold or the oil move is actually very identical to what happened in cable the week prior. So in cable the week prior, we had this kind of bottom formation. We had that aggressive short-term recovery back into the value area. And when you look at the 1 hour curve, we actually have almost an identical type of structure. Aggressive recovery, as I said, back into value area, period of consolidation, break up, break down, move back to value area, ultimately reject. And also, what do we have on oil prices? Break up into a period of consolidation, take the highs, take the lows, back to value area, and we unwind. So for me there now, that is very interesting this week, because as I said, if we break underneath that 59.80, the probability is that oil price actually slides deeper, and really wouldn't be surprised if we saw 58.50 on oil prices. And again, when you look at what happened in cable after the move, actually cable in the following, let's say, week and a half into last week, into this week, has actually gone back into those prior lows between 132.50 and 133. So for me, that's going to be very interesting, because who's to say this actually holds up and we could actually see price action just trend lower back into this prior consolidation zone, which is really in that 56, 57 barometer. So interesting type of play. It's just how the formation kind of engineered and developed itself. Almost identical structure, consolidation, as I said, take the highs, take the lows, back to value area, sell off. And as you said, you've seen the exact sort of same thing in cable. Aggressive rally into consolidation, take the highs, take the lows, and then of course from there it's just a case of steady selling back into those structural bottoms. So for me, obviously quite an interesting scenario. I think it's worth noting as well, over the last kind of 2 weeks or so in the FX markets, definitely cable has been on the back foot, purely because of what's happening in the UK equity markets. And that is also a very, very interesting scenario as well, when you look at Euro Pound, when you look at Pound Aussie, Pound Kiwi, if you're FX trader, but also just looking purely at Pound Dollar, that even despite a mixed sentiment in the DXY, where it's kind of faffing about 98s, high 98s, low 99s, cable is still trending lower, which ultimately shows how weak the pound currently is. But how weak the pound currently is really attributed to how aggressive the FTSE stock index is in the UK at the minute. And of course, seeing the FTSE move aggressively up from where it was last week off of those UK data prints. It was at 94 last week, it traded at 97 today. So it really, in the space of less than a week, the FTSE 100, which for years, for decades has been a notoriously consolidated index, has moved 300 points in 4 to 5 trading days. And of course, you're seeing that again on the volume profiles. Now for me, I think again, into this week, not too much in terms of UK data prints, because of course we've had a lot of our data prints already out. It's really just a case of structural price action, and really if there is any sort of risk aversion, so i.e. short-term profit taking against stock market indices, you're really just seeing kind of an unwind and correctional play against the FTSE. And of course, given of course the FTSE had prior all-time highs between 95.50 and 96, we got to it on Thursday. We broke above it, we kind of held, we consolidated, and then on Friday we broke continuously higher into a new all-time high close on Friday evening. It's then seen markets obviously pivot into a consolidation yesterday, and really into this morning, where again we've then continued higher again. So from that perspective, short-term correctionals are worth watching on the FTSE play. But if we were to pivot, let's say Wednesday, more risk off, spike in the VIX, where you actually see that VIX move back up into that kind of 17 and a half, 18 barometer, then you're obviously looking at S&P is correcting, NASDAQ potentially correcting, and probability is you'd actually see the FTSE correcting. So you've got area 1 here around that 96.50 handle, but for me, you've actually probably got a deeper level down here at prior all-time highs, which is down here around 95.50, 9500, and it's really in this platypus down here where we broke up from last Wednesday. So do keep an eye on those corrections. As I said, we're seeing it across the board. We're seeing ability and nimbleness of markets to correct from session to session. We've seen it in the crypto space, we've seen it in the equity market space, we've seen it in the VIX volatility curve, which for me has been so evident, as I said, for the last number of months. But we're even seeing it in alternative assets like the soft commodities, like your liquid commodities like oil, and of course gold, which is just completely unfolded on itself from middle of last week. So it's just something to be very, very conscious of. As I said, for me this week, risk rally is seems to be somewhat abating after that very, very aggressive move Thursday, Friday into Monday. Whether that continues or not is really dependent on how the VIX reacts over the course of the next few days. But as I said, really wouldn't be surprised now, given, of course, we've looped up and looped all the way back down, if we were to see the VIX kind of hang about this 15, 17 range and just move up and down. And if that is the case, then we probably see a little period of respite where we might get a short-term correction, and then it's a case of, do we start to see market stabilize again for another preemptive accumulation phase for our next leg higher. So again, markets very, very interesting at the minute, across the board, whether it's DXY, whether it's the euro, in FX side of things, or pound, whether it's the gold markets with that incredible apex up and back down, whether it's that breakdown in oil, which seems to replicate, or has given early signs it's looking to replicate cable price moves over the last few weeks with this up and back down again, or if it's a case of equity markets where there is a little bit of an unwind. But as I said, session to session, let's see how things go. These are obviously deeper corrections, as I said, when we like to see these deeper corrections. But even from a short-term perspective, look to see how markets react off of the value area. So today, for example, on the open, we into 230 or into 130 today, we saw markets obviously spike. We got the correction, and then of course 3 into 4 o'clock we actually saw US markets leg higher into the close or into the latter part of the session. But those value areas have proved to be pivotal. We saw it on Monday, we saw it again yesterday, and of course we saw it last week as well, last Thursday, when we got that short-term break above value area. We held above it last Thursday, and that really segmented price structure to develop or to actually progress through the course of the session, ultimately to where it got to all-time highs again this week. So let's see how things develop over the next kind of day or so. Obviously, for me, it's at the latter end of the year, when trends become more amplified, it's all about either finding dip opportunities and being able to carry trades, or if it's short-term positions, looking for short-term sentiment. So your ladders on the shorter time frames are very, very pivotal. Breaks and holds of value area, like for example today, break out, come back to value area, hold it, and then segment higher. Those are the shorter time frame movements if you're looking to trade as a day trader, not necessarily as a swing trader as well. All right, so that's kind of where we're at the minute. Overall, markets, again, phenomenally doing very, very well. Risk is obviously down from last Monday, last Tuesday. Obviously from Thursday, it's really been elevated to the downside. But we're really looking to see whether that continues into FOMC on Wednesday, and really looking to see how does that progress. Because as I said, you've got obviously Friday being month end, hugely progressive month for a lot of funds. We start to see then, is there profit taking into month end as well, as we sit in the midst of half term or midterm break for the school system as well. All right, so guys, that's where I'm going to leave it tonight. On the 1 day performance, as I said, VIX is obviously up today, but segmented down lower over the last week. Equity markets probably a little bit more flat in Europe, with the exception of the FTSE obviously moving higher. Equity markets in the US narrowly higher, so S&P's up, Dow up, NASDAQ obviously up, but whether that remains the case into the next hour or so is going to be interesting, given of course how expansive we've been over the last number of hours. And then, of course, as I said, over the next week or two, we're going to start to become a little bit more familiar with earnings. So we're not massively kind of focused on earnings at the minute. It's more something to look out for as we move into November, more broadly speaking. Hopefully by that stage, we'll have an end to this government shutdown, where we start to get our GDP prints, where we start to get our S&P prints, our PMI prints, our core PCEs, etc., etc. So that's really going to be something to watch as we move into November. So hopefully we'll start to see an end to this government shutdown as well. All right, so guys, I'll be back tomorrow for US Open. Really just kind of looking to see how this price structure develop. Kind of interesting to see, given of course that we have obviously the Fed tomorrow evening, we've Bank of Canada tomorrow afternoon. I'm probably on face value, I'm not expecting much in the open call tomorrow. I think if they're anything like myself, it's going to be really kind of holding fire, keeping all of the bullets and ammunition for tomorrow night to see if there's any sort of medial reaction from the FOMC at 7 p.m. All right, so guys, that's where we're going to leave it tonight. Price structure overall, very, very confident. Overall, doing quite solid, quite well, despite the short-term pickup in the VIX today. But as I said, tomorrow's a new day, and we could very easily see markets pivot again if it's a case we see volatility pick up or extrapolate further to the upside. All right, have a good evening, everyone. Take care. Thank you very much.